Hi, this is Juliet, a young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of Part 8 about investments in equity securities and debt securities. I discussed in Part 8 about investment in debt securities. Just click above or the link below this video to watch Part 8. In this video, I am going to discuss about the held to maturity securities. Held to maturity securities. Initial recognition and measurement after initial recognition. Held to maturity securities shall be initially recognized at purchase price plus transaction costs, because these debt securities are intended to be held until maturity and at the holding enterprise demonstrate an ability to hold them until maturity. It is necessary to periodically amortize the difference between the cost of the investment and its face value over the term of the debt instruments. The amortization gradually adjusts the original cost of the instrument such that on maturity date, its carrying value equals its face value. Pass number 39 requires the use of the effective interest method for the amortization of discount or premium on held to maturity securities. The effective interest method applies the actual interest rate, called the effective interest rate or the yield, to the carrying value of the instrument to determine the interest income during the interest period. The effective interest rate is the rate that exactly discounts estimated future cash receipts or payments through the expected life of the financial instrument, or when appropriate, a shorter period to the net carrying amount of the financial asset or financial liability. The calculation of the effective interest rate includes all fees and points paid to the contract, transaction costs, and all other premiums and discounts. When bonds are purchased at more or less than their face value, the premium or discount is not shown separately, but rather included as part of the investment cost, or netted against the investment cost. Amortization of premium include of transaction costs on held to maturity bond investment decreases the interest revenue based on nominal rate and the investment carrying value, whereas amortization of discount net of transaction costs on held to maturity bond investment increases the interest revenue based on nominal rate and the investment carrying value. To reiterate, the purchase of bonds at less than face value resulting to a discount indicates that the bond interest rate is less than the prevailing market rate. The adjustment for discount amortization will therefore increase the recorded nominal interest, bringing interest revenue equal to the effective or market rate. At the same time, the carrying value of the investment will increase each period by the amount of the discount amortization. On the other hand, the purchase of bonds at more than face value resulting to a premium indicates that the bond stated rate is more than the prevailing market rate. The adjustment for premium amortization will therefore decrease the recorded nominal interest, bringing the interest revenue equal to the effective or market rate. At the same time, the carrying value of the investment will decrease each period by the amount of the premium amortization. For a complete illustration, assume a bond investment with face value of 1 million pesos and stated interest rate of 15% is purchased by ABC Corporation for 1,110,401 peso. A price to yield 12% with interest payable semi-annually. The entry to record the acquisition of the bond investment classified as held to maturity is as follows. Debit, held to maturity securities, XYZ bonds, 1,110,401 pesos. Credit cash, 1,110,401 pesos. Acquired 1 million face value bonds on XYZ classified as held to maturity. Subsequent to acquisition, the held to maturity securities shall be recognized on the statement of financial position at amortized cost using the effective interest method. The effective interest method produces a constant rate of return to the investment. The rate of return is the computed effective interest rate determined at the date of the acquisition. In our example, the effective rate of interest is 12% annually or semi-annual effective interest rate of 6%. Assume that the bonds purchased stated were dated January 1st, 2007 and were purchased by ABC also on January 1st, 2007. Further assume that interest payment dates are June 30 and December 31st and the bonds mature on December 31st, 2011. A complete table for premium amortization is presented as follows using the effective interest method. Table of premium amortization effective interest method. The entry on June 30, 2007, the first interest collection date is debit cash for 75,000 pesos. Credit interest revenue, 66,624 pesos. Credit held to maturity securities, XYZ bonds, 8,376 pesos. Alternatively, two separate entries may be made every interest collection date. An entry for the collection of interest and another for the amortization of premium or discount. Debit cash for 75,000 pesos, credit interest revenue for 75,000 pesos, collection of interest. Debit interest revenue for 8,376 pesos and credit held to maturity securities, XYZ bonds, 8,376 pesos, amortization of premium. Similar entries will be made every interest collection date. The amount of amortization of premium is based on the stated table. The entry compounded on December 31st, 2007 is debit cash for 75,000 pesos, credit interest revenue for 66,122 pesos, and credit held to maturity securities, XYZ bonds, 8,376 878 pesos. If the bond year does not coincide with the accounting period, the amortization of premium or discount must be updated at each reporting date. To illustrate, assume that XYZ bonds in our preceding example are dated March 1st, 2008 and mature on March 1st, 2013. Interest is payable by XYZ every March 1st and September 1st. ABC acquired the bonds on March 1st, 2008. ABC reports its financial statements on a calendar year basis. The partial table as follows shows the premium amortization using the effective interest method. The entries in the books of ABC for the year 2008 are 2008 March 1st, debit held to maturity securities XYZ, 1,110,401 pesos. Credit cash, 1,110,401 pesos. September 1st, debit cash for 75,000 pesos, credit interest revenue 66,624 pesos, and credit held to maturity securities XYZ 8,376 pesos. December 31st, debit interest receivable 50,000 pesos, credit interest revenue 44,081 pesos, and credit held to maturity securities XYZ 5,919 pesos. 75,000 pesos times 4 divided by 6 is equals to 50,000 pesos. 66,122 times 4 divided by 6 is equals to 44,081 pesos. 8,878 pesos times 4 divided by 6 is equals to 5,919 pesos. The adjusting entry stated updates the interest revenue and recognizes the accrued interest from September 1st, 2008 through December 31st, 2008. On December 31st, 2008, Statement of Financial Position, the held to maturity securities shall be presented as part of non-current assets at its amortized cost of 1,096,106 pesos or 1,110,401 less 8,376 less 5,919. On the Statement of Comprehensive Income for the year ended December 31st, 2008, total interest revenue taken to profit or loss on account of this investment is 110,705 pesos, which is 66,624 pesos plus 44,081 pesos. The following are the entries relating to the investment during the year 2009. 2009 March 1st, debit cash for 75,000 pesos, credit interest receivable 50,000 pesos, credit interest revenue 22,041 pesos, credit held to maturity securities XYZ for 2,959 pesos. 66,122 less 44,081 is equals to 22,041 pesos. 8,878 less 5,909 is equals to 2,959. September 1st, debit cash for 75,000 pesos, credit interest revenue 65,589 pesos, credit held to maturity securities XYZ 9,411 pesos. December 31st, debit interest receivable 50,000 pesos, credit interest revenue 43,349 pesos, credit held to maturity securities XYZ 6,651 pesos. 75,000 pesos times 4 divided by 6 is equals to 50,000 pesos. 65,024 times 4 divided by 6 is equals to 43,349 pesos. 9,976 times 4 divided by 6 is equals to 6,651 pesos. In the December 31st, 2009 statement of financial position, the held to maturity securities shall be presented at an amount lower than last year due to the effects of premium amortization. Its amortized cost on December 31st, 2009 is 1,077,085 pesos, computed as 1,096,106 less 2,959 less 9,411 less 6,651. Meanwhile, the interest revenue reported in profit or loss of the statement of comprehensive income is 130,979 pesos. It is computed as 22,041 plus 65,589 plus 43,349. For convenience, amortization of premium or discount may be made in full only at year-end as part of the entity's adjusting entries. Purchase of bonds between interest payment dates. If bond investment is purchased between interest payment dates as previously discussed and illustrated, the buyer should pay, in addition to the purchase price of the bonds, the amount of accrued interest from the last interest payment date. To illustrate, assume that A Corporation on March 1st, 2008 purchased 300,000 of 8% C Company bonds for 277,870 plus accrued interest. The bonds pay interest annually every December 31st and mature on December 31st, 2012. A corporation has to pay a total of 281,870 pesos to acquire the bonds. 281,870 pesos is the total of the purchase price of 277,870 pesos and accrued interest of 4,000 pesos, which is the amount of accrued interest from December 31st, 2007 through March 1st, 2008, computed as 300,000 pesos times 8% times 2 divided by 12. The entry in the books of A Corporation to record this acquisition is as follows. Debit held to maturity securities C Company bonds 277,870 pesos. Debit interest receivable 4,000 pesos. Credit cash for 281,870 pesos. Purchase C. Company bonds. Using a financial calculator or an Excel worksheet, the effective interest on this investment is determined at 10%. A table of discount amortization is presented as follows. The following are the pertinent entries during 2008 and 2009. 2008, December 31st, debit cash for 24,000 pesos, debit held to maturity securities C Company 3,156 pesos, credit interest receivable for 4,000 pesos, and credit interest revenue for 23,156 pesos. Year 2009, December 31st, debit cash for 24,000 pesos, debit held to maturity securities C Company 4,103 pesos, and credit interest revenue for 28,103 pesos. Notice from the stated entries that the discount amortization for the period is charged to the investment account or HTM. This gradually increases the amortized cost of the investment as maturity date comes nearer. On December 31st, 2008 and December 31st, 2009, Statement of Financial Position, the held to maturity securities shall be presented at its amortized cost of 281,026 pesos and 285,129 pesos respectively. Disposal of held to maturity securities. When an investment classified as held to maturity securities is sold before maturity date, the investor shall update the amount of premium or discount amortization. Amortization should be taken up until the date of sale to update the carrying value of the investment sold. Based on the amortization table prepared earlier, the following is taken pertaining to XYZ bonds held by ABC Corporation as held to maturity securities. Assume that on March 1st, 2011, ABC Corporation sells the bond investment at 101 plus accrued interest. ABC Corporation appropriately made adjustments for the premium amortization on December 31st, 2010. The following entries will be made on March 1st, 2011. Debit interest revenue for 4,450 pesos and credit held to maturity securities XYZ bonds 4,450 pesos. Amortization of premium from January 1st to March 1st, which is 13,350 pesos times 2 divided by 6. Debit cash for 1,035,000 pesos. Debit loss on sale of held to maturity securities 13,045 pesos. Credit held to maturity securities XYZ bonds 1,023,045 pesos. Credit interest revenue for 25,000 pesos. The cash received upon sale is computed as follows. Sales price 1 million pesos times 101% is 1,010,000 pesos. Accrued interest 1 million times 15% times 2 divided by 12 is 25,000 pesos. Total cash proceeds is 1,035,000 pesos. The loss on sale is computed as follows. Carrying value December 31st, 2010, 1,027,495 pesos. Less amortization from January 1st to March 1st, 2009 is equals to 13,350 pesos times 2 divided by 6 is equals to 4,450 pesos. The carrying value March 1, 2011 is 1,023,045 pesos. Selling price 1,010,000 pesos. Loss on sale 13,045 pesos. The gain on sale of investment is presented in profit or loss as part of other operating income, while any loss on the sale of investment is classified as part of other operating expenses or losses. It is noted that when an enterprise sells more than an insignificant amount of held-to-maturity investments before maturity date, the ability of the company to hold any securities until maturity is tainted. Thus, any remaining held-to-maturity investments shall be reclassified as available for sale securities. However, the following sale of held-to-maturity securities will not affect the classification of the remaining investments of the entity. Letter A. Sale of held-to-maturity securities that is so close to maturity or the financial assets call date. For example, less than 3 months before maturity date. That changes in the market rate of interest would not have a significant effect on the financial assets fair value. Letter B. Sale that occurs after the entity has collected substantially all of the financial assets' original principal through scheduled payments or prepayments. Or letter C. Sale that is attributable to an isolated event that is beyond the entity's control, is not recurring, and could not have been reasonably anticipated. Impairment of held-to-maturity securities. Impairment loss on held-to-maturity securities is recorded either directly crediting the investment account or through the use of an allowance account. The amount of the loss is measured as the difference between the asset's carrying amount or amortized cost and the present original effective interest rate at initial recognition. The amount of the loss shall be recognized in profit or loss. The entry to record the impairment is debit impairment loss held to maturity securities and credit held to maturity securities or allowance for impairment in value of held to maturity securities. If in a subsequent period, the amount of impairment loss is recovered and the recovery can be related objectively to an event occurring after the impairment was recognized, the previously recovered impairment loss shall be reversed either directly or by adjusting an allowance account. The reversal of impairment loss shall not result in a carrying amount of the financial asset that exceeds what the amortized cost would have been had the impairment loss not been recognized at the date of the impairment is reversed. The amount of the reversal shall be recognized in profit or loss. Paragraph number 65, IAS number 39. The entry for the reversal of impairment loss on held to maturity securities is debit held to maturity securities for allowance and credit recovery in market value of held to maturity securities. Thank you for watching my video. I hope you learned something from this video. I did part 10 and continuation of this video wherein I discuss in part 10 about the debt securities classified as available for sale securities. Just click above or the link below this video to watch part 10. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet See you on my next video.